Now, for more on the intricacies of China's stock markets, let's bring in Thomas Hayes. He's chairman and managing member of Great Hill Capital. Always good to have you on.
Thanks, Rachelle.
So in terms of the size and pace of Chinese IPOs from 2020 heading into 2021, what's really stood out to you about this momentum?
Well, Chinese IPOs in particular are at a 10-year high in terms of size and volume last year. And in the US, despite the tensions, in 2020, 32 Chinese companies listed. They raised $12.1 billion of capital. That's the most since 2014 when Alibaba went public. And in Hong Kong, they did $52 billion of deals. They've already done $10 billion this year, so they're going to outpace a record year last year. But we have to keep in mind, Rachelle, that there are currently 200 Chinese companies listed in the US. They've got about a $2 trillion market cap, and about 1.2 trillion of that is US holdings. So the US capital markets are critical for Chinese companies, and we are seeing some of them take secondary listings in Hong Kong and IPO in Hong Kong, but we have to look forward and see that this gets worked out in the coming 12 to 24 months.
So then, given that relationship then, what's your outlook for this year's IPO market, and what are some of the major Chinese IPOs that we can expect? What are you keeping an eye on?
Yeah, well, you certainly have the Uber of China. Didi is going to go public at a $60 billion valuation in Hong Kong. And the crux of this, the tension, is the Holding Foreign Companies Accountable Act, which was passed in December. And it really has two components. The first component is that foreign companies listing in the US abide by our auditing standards, the same auditing standards that US companies have to abide by. And then the second thing is that they have to disclose any ownership or involvement of their government in the company in order to list. And part of the reason for that is last year there was Luckin Coffee, where the CFO fabricated about $310 million of sales, and US investors lost billions of dollars on that deal. So it's a protection for investors from foreign companies that they just follow the exact same standards that the US companies have to follow.
So then, given the current environment, then we are seeing a lot of companies either listing in China or Hong Kong, or perhaps even doing a dual listing. What does this mean perhaps for Hong Kong standing as a financial hub if more and more IPOs do continue to go there?
Well, certainly some of the fastest growing companies are coming out of China, and Hong Kong will gain some of those listings where the principals don't want to abide by the new standards in the US exchanges. So the US exchanges will lose some of that business. But I think moving forward, I think this administration will probably overlook some of the ownership issues moving forward and just focus on the auditing standards, and that will enable some greater flexibility in the IPO market moving forward. But as Mr. Terrett said prior to my segment, this is probably a secondary focus after getting the vaccinations out, after dealing with the domestic economy, domestic stimulus, which we've seen so much focus on in the first 100 days.
So then, given the domestic priorities in the US, then, when do you think we might see some of these leftovers from the Trump administration being addressed when it comes to Chinese companies listing on US exchanges?
Yeah, I think that's secondary, and I think also this administration wants to work with other allies to come to some agreeable solution that does keep the standards in place in terms of auditing. And also the key thing with the Trump blacklist, the Trump administration blacklist, was parsing out military ties. I think that blacklist is complete, so I don't think we're going to see major additions. And if anything moving forward, you may see some subtractions moving forward, and that should stabilize the relations, and it should stabilize the IPO flow, both in the US and in Hong Kong. Both are critical capital markets for fast-growing companies.
So for the companies that are choosing to list in Hong Kong, what would you say are the biggest benefits of that?
Well, I think number one, the auditing standards are less stringent. The ownership disclosure standards are less stringent. They can get to market more quickly, and Hong Kong is loosening some of its standards as it relates to SPACs, which have been very popular in the US special purpose acquisition vehicles. Generally, it'll enable them in this period of uncertainty to list quickly. Institutional managers from around the world can access Hong Kong shares as quickly as they can access US shares, so that's not a key factor. And that will probably be some of the balancing act moving forward until there's a definitive standard from the new administration in coming months.
And just quickly, we have about 20 seconds. What are you watching in terms of stock market bubbles in both China and the rest of the world, especially as a result of these pandemic-related measures from some of these central banks over the last year?
Well, I think the number one thing, Rachelle, is interest rates. They went up very, very quickly, the 10-year yield. That has stabilized since Bank of Japan's Kuroda decided to keep the band narrow on Friday, which means that U.S. rates should stop going up, and the Bank of Japan will start to be a net buyer of U.S. Treasuries once again. They had been a net seller for the last 5 years. And as those rates stabilize, money's going to go back into emerging markets, back into China after a little correction we saw, back into tech, and back into some of the higher yielding stocks that have been neglected for the past 2 months.
All right, thank you as always. Thomas Hayes there, founder, chairman, and managing member of Great Hill Capital.